The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the line from the far west coast of America, I have Robert Blumen, who has written a very interesting piece entitled Misunderstanding Gold Demand. Welcome to the podcast, Robert.
Thank you for having me, Alistair.
It's very much my pleasure. I'm very pleased that you've written this piece. I know you've spoken to James Turk before on this sort of subject. But if you could give us a little bit of background, I mean, why you've written the piece. You say misunderstanding gold demand. Who is it that misunderstands gold demand? And what actually do you mean by misunderstanding? Perhaps if you could give us a brief intro, Robert, that would be helpful.
Yes, you've asked several questions there. The first one is, why have I written this? Some years ago, I realized that the way that most of the analysis of the gold market is done is pretty much wrong. I've written a series of pieces which are all coming at that from a different direction. I mentioned my previous discussion with James Turk was primarily on the subject of why mine supply is not the primary component of the supply side of the market. This piece is looking more at the demand side, although, pardon me, it does deal totally with both sides of the market.
Right. So, I listened to the podcast with James about mine supply, and I think if I can summarize it, and tell me if I've got it wrong, really what you're saying is that because there is the existing stock of gold sitting there, the incrementation of a further 1 to 2% of new mine supply every year actually matters considerably less than what people who are already sitting on gold actually do and think. Have I got that? I mean, it's a gross oversimplification, perhaps, but is that roughly what the story is?
I think that really is it exactly, and I wouldn't call it an oversimplification. I think it's a perfect summary of what point I was trying to communicate when I talked to James.
Right, so this time we're looking more at the demand side. Would you like to say a little bit more about how you see the demand side?
Yeah, well, I was talking about both sides of the market because, as we all know, markets form prices based on supply and demand. There's a certain amount of gold out there. Every piece of gold is owned by somebody. What the market does is it enables those people who have the greatest economic motivation to own gold end up owning all the gold. And they don't really care whether if they have to buy it from a miner or from somebody else who already owns some. There's a bidding process, which is the same as for any asset, like land, property, shares. The people who place the highest value on each unit will end up with all of it. The demand side, it's the same thought process, but in terms of money, the people who place the greatest value on money will end up with the largest cash balances. The gold market is the trading between people who have cash and people who have gold, where they're all trying to sort out what is the mix of cash, gold, other assets, and consumption goods that they want to own.
So essentially, I mean, this is the function of the market, isn't it? It's the forum where people, as you say, who have cash and want gold, or have gold and want cash, come together, meet, and one way and another, it sorts itself out, and the price is the adjustment factor, so that at the end of the day, people are broadly satisfied. I think that's again a bit of an oversimplification.
Yeah, the difference between gold and markets for most other commodities is most other commodities, the supply consists of whatever was produced recently. There's not a lot of stockpile, and the demand is primarily a demand to take it off the market and destroy it, to use it up. So the price serves to ration the flow of production into different forms of destruction. Whereas for an asset like gold, it's about who has the greatest motivation to hold on to it, because it's not destroyed. Every year, a little more gold is produced than what is physically destroyed. And so we're all really engaged in this bidding process of who has the greatest motivation to hold gold against some other thing that you could hold instead, which could be money or an asset, or it could be any type of consumption that you would prefer.
Right, and this is, as you rightly say, a completely different approach from the mainstream analysts who cover the gold market. I mean, they tend to think in terms of investment demand, mine supply, fabrication demand, jewelry, whatever, and they don't really look at it this way. Am I right?
You're absolutely right, Alistair. We all, if I ask you, is the following statement, is this a true statement? The price of gold is set by supply and demand. Everyone agrees on that. But then you look at how most analysts cover the market, and the thing they're calling supply and demand, these are market volume numbers. If it's a gross, like mine supply is a gross, or the total amount of scrap coming to the market is a gross, or they're nets, like the net investor purchases, which is the gross purchases minus gross sales. So these are numbers. I wouldn't call those supply and demand. I call them the quantity supplied and the quantity demanded. And the market price is not set by the quantity supplied and the quantity demanded. But you would think that if you read most of these reports.
Yeah, I think that's right. And the other fallacy I think these reports have is that very often they look at investment demand, for example, and calculate that as a residual figure. If they've got, let us say, a supply of 2,700 tons and they can only identify demand for 2,200 tons, they then assume that the other 500 is entirely investment demand. And so I think that there are big faults in the way in which the mainstream approach this. Your approach, I think, is more a sort of, if you like, an Austrian economics approach. I mean, would you like to just say a little bit more about why you're thinking this way?
Yeah, well, I was very much influenced by the Austrian version of marginal price theory, which I learned from Murray Rothbard and his book, Man, Economy, and State, in which he discusses the formation of exchange ratios. And he has a whole chapter on money and establishing the purchasing power of money. And when I started thinking about this, I realized that same logic applies to the gold market or any market where you have a stock of a good that people are bidding from the other side in order to hold it. But not to give too much credit to the Austrians, I understand that marginal price theory is pretty much the same in all of modern microeconomics. So I happen to get it from this one source, but I don't think the Austrians have a monopoly on that.
No, I think that's right. I think where the difference is that the Austrians, if you like, I mean, like Murray Rothbard, I think laid out pretty well what you referred to as schedules and which he referred to as schedules, sort of levels at which buyers might sort of change their marginal demand, for example. And from that, in theory, you construct supply and demand curves. The Austrians, I think, take the view that none of this is basically predictable. So it's only a framework for a thought process rather than something that is actually useful. Other economists take it, I mean, particularly the Cambridge School, take it as the mathematical basis for prediction, which is what the Austrians do. Anyway, that's we're getting off the point a little bit, but that's how I see it. So we now come back really to the price of gold. I mean, how do you see the price of gold being set in between these dynamics, the sort of the schedules and marginal pricing effects and so on and so forth? Would you like to say something about the price and how the balance is achieved?
You could think of it in the following way. If we got everyone together in a room who either owned gold or wanted to own gold, and everyone has the ability to bid either side of the market for more dollars and less gold or less dollars and more gold, then following the marginal price theory, there would be some price where everybody who has a possibility of making an exchange to improve their mix of dollars and gold, or I say dollars, but any currency, will have the opportunity to make an exchange with someone on the opposite side at what we call the equilibrium price. That's basically it. Now, the market doesn't have everyone in the same room, the real gold market, but it is a very efficient market that operates somewhere in the world on a 24-hour basis, and you won't see gold trading at a very far different price in one market than another market. So in a sense, Alistair, if you wanted to buy some coins and there's a seller in China who wants to sell, you could buy those coins with maybe a little transaction cost.
Yeah, so there's really, it is a pretty efficient market. I should add, what you haven't gone into, and I think that it is, to be fair, beyond the scope of your report, is the different types of buyers, in the sense that, you have hedge funds who will tend to think one way, tend to think, rather than, because it's within a herd, within a herd total, there are individuals who have completely differing views. You've got strategic acquirers of gold, for example, and even strategic sellers of gold. And of course, none of these hands are rarely declared. And I think really what we're looking at is just this sort of, if you like, how the market works, rather than who is in the market at any one time. So in that sense, perhaps all the gold in the world, I mean, it's not really for sale in some sense. And presumably, if you get a rising price, you'll get a change in views. Someone who previously might be prepared to sell, say, at $10 above the current price, sees the price rising and thinks, well, I'm not going to sell because it looks too good. How does that fit in with your thinking, that sort of reverse logic, as it were?
Well, Alistair, the way I understand the supply side is every ounce of gold out there has a price tag on it. That's the point where the person who owns that ounce of gold would be willing to sell it to the market. All the people who own the gold now own it because their price tag is above what they can get for it. The other thing I think it's important to understand is an individual who owns gold and might be willing to sell it at some price. The price is not necessarily a number of dollars or euros, because money is only one of the alternative things that could be done with that wealth that is currently embodied in gold. You have to think of the price of owning gold as the sacrifice of the opportunity to own either another asset or a consumption opportunity. So if, for example, here's a good example. The Dow stock index on the U.S. stock market is now, I think, 6-7 ounces of gold for 1 unit of the Dow. If you could buy 1 unit of the Dow for 1 ounce of gold and it was yielding 8%, I think a lot of people would swap some of their gold for stocks. Or if you could buy that new car for 1 ounce of gold, maybe instead of owning 20 ounces of gold, you'd rather own 19 ounces of gold and a new car. So we have to think of price more broadly as the opportunity that you are sacrificing to be in some other economic good by your choice to own gold.
Yeah, no, I think that does make sense. I would add that I place quite a big emphasis on this being at any one moment, because if you had a situation where instead of 6 or 7 ounces to buy the Dow, it was 1 ounce and it was yielding 8%, you might take fright and say, hold on a minute, do I really want to buy something that's tanking so badly? I think the temporal aspect is very, very important. Broadening it out a little bit, how do you view gold generally? I mean, what has driven you to an interest in looking at the pricing of gold?
When I was growing up in the 70s, the U.S. was experiencing a time of very high inflation. So before I knew anything about economics, I remember seeing a young man on television who had ratted out his local store for violating Nixon's price controls, and he was being interviewed on a television program. So I had a curiosity of what is the cause of inflation. And I also lived through, although I was quite young, the huge gold bull market. So it was something I had a curiosity about, and I began to learn about economics and the Austrian school, which really emphasizes the historic role of gold as money and the different costs associated with the different types of monetary systems. So it's always something I've had an interest in. My view of money or of gold is that it is not money at this time because money is something which is accepted generally as a medium of exchange, meaning accepted as payment for most goods and services within economy. I see it more as, I use the term shadow money, which is something that people hold as a possibility that it may become money in the future. And also, I believe it serves as a check on the behavior of the people who run the current monetary system, because as much as they might like to think that they decide what money is, ultimately they don't. And ultimately, their ability to force the rest of us to use their centrally planned system is limited by their willingness to maintain some store of value in the currency. And if they're not able to do that, then people will choose something else.
I think that's a very interesting response with which I completely agree. Well, our readers might be interested to find more of your writings. I think I'm right in saying that sometimes you're published on Lou Rockwell, sometimes it's Zero Hedge, perhaps? Did I see this report on Zero Hedge?
I'm not aware if Zero Hedge is linked to it, but they may well have.
Yeah. So when you write reports like this, I mean, they do get an airing on the blogosphere. And also, I think our listeners, if they'd like to care to go back, they will find the earlier podcast you did with James Turk, which I think is also of interest. So what I would like to say, Robert, is thank you very much indeed for taking time out to speak to us. And we'll look forward to seeing whether anybody else picks up your better analysis of how things work rather than the straightforward, traditional mining analyst approach. Thank you very much indeed.
Thank you for having me, Alistair.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.